All right, let's talk about something that trips up almost every single investor out there. We're going to break down one of the most common and maybe one of the most dangerous beliefs in all of finance, our own expectations about how much money our investments are supposed to make. So let me ask you a question, straight up. When you put your hard-earned money into the market, what kind of return are you actually hoping to get each year? Go ahead, get a number in your head. Okay, if that number in your head was something like 10% a year, well, you're not alone, not even close. This is probably the most common answer you'll hear from just about anyone. It's almost like the default setting for our expectations, right? Or, hey, maybe your answer was a little less about the number and more about the goal, something like this: enough to retire early. I mean, that's the big dream, isn't it? The idea that our money will just magically compound and get us to the finish line way ahead of schedule. But here's the thing, and this is really the whole point of what we're talking about today. If your expectations are that high, it's probably not your fault. Seriously. The way we all talk about investing, the way it's sold to us, the entire system kind of quietly encourages us to overestimate what's possible. So let's back up. Where did this big idea, especially that magic 10% a year promise, even come from? Let's trace it back to the source. Well, it's pretty much everywhere you look. You see it in flashy headlines when the market hits a new high. It's baked into the historical averages that get thrown around all the time. You hear these incredible success stories from friends or, on social media. And of course, you see those super simplified charts that always just go up and to the right. It looks so easy. Okay, but let's be super clear about something. That 8 to 10% figure, it's not a lie, it's not made up, it's based on real historical data. The problem is, it's a totally incomplete story. And that missing piece of the puzzle, that's exactly where we get into trouble. And that leads us right here to what I like to call the myth of averages. This is where the clean, neat projection we're sold just completely falls apart from the messy reality that you and I actually have to live through. And there it is, 10%. Big, bold, simple. It's so promising, isn't it? This one number is the foundation of so many of our expectations, the anchor for our financial plans. But what even is this average we're talking about? Well, it's basically a perfectly smoothed out math problem. It assumes you invested your money and then just never touched it. Never panicked, never sold during a crash, never missed a big rally. It's a lab experiment number, not a real world one. So check this out. On the left, you've got the idea we're sold, that smooth, steady, predictable climb. But on the right, that is what investing actually feels like. It's jagged, it's volatile, it's an emotional ride with terrifying drops and thrilling peaks. Let me tell you, no investor in the history of the world has ever experienced that smooth line on the left. Ever. Okay, so if that smooth line isn't real, what's actually happening to our money? I want you to think of your portfolio like a bucket. The market is pouring these great returns in the top, but there are these invisible leaks draining your money right out the bottom. And that brings us to the biggest leak of them all. It's called the behavior gap. This isn't just some theory, by the way. It has been documented for years and years. It's the very real, measurable difference between what the market returns and what the average investor actually gets. And guess what causes it? Almost entirely our own emotional decisions. And here's the classic cycle that creates that gap. When the market is flying high and everybody feels like a genius, our greed kicks in. We're afraid of missing out, so what do? We buy high. Then, when the market inevitably turns and drops, fear takes over. We sell low to stop the bleeding. It is the exact opposite of what we're supposed to do, and it is a massive drag on our returns. All right, what's another leak? Fees. Oh man, fees. A 1% management fee sounds tiny, right? Almost harmless. But do not be fooled. Fees compound against you. As you can see here, over 30 years, that tiny little fee can just devour a shocking chunk of your final nest egg. So when you add all these leaks up, the fees, the taxes, our own behavior, you get a picture that looks something like this. That big market return number you hear about on the news, it gets chipped away from every single side. A piece goes to fees, another to taxes when you sell, and often the biggest slice of all gets lost to our own emotional roller coaster. What you actually get to keep can be way, way smaller than the headline number you were hoping for. Okay, let's dig into one last really crucial idea here. Volatility isn't just an emotional thing. it has a real mathematical penalty that most people just don't think about. This is what we call the brutal math of recovery. So picture this. It's not some crazy hypothetical. Major market crashes happen. Your portfolio takes a massive hit. It loses half its value. Your $100,000 is suddenly $50,000. Ouch. So here's the million-dollar question. After losing 50% of your money, what percentage gain do you need just to get back to where you started? Take a second. Your gut probably says 50%, right? Nope. The answer is 100%. You need to double your money just to break even. This, my friends, is the volatility trap. Big losses are mathematically so much more damaging than big gains are helpful, and that average return number we see everywhere, it completely hides this painful, painful math. So after all that doom and gloom, what's the point? Are we supposed to just be pessimistic and give up? Absolutely not. The point is to shift to a smarter way forward, one that's built on the power of being a realist. You see, blind optimism, it sets us up for these crazy high hopes, but it also leads to huge disappointment and, frankly, terrible decisions when those hopes don't pan out. Realism, on the other hand, it leads to better planning. It probably means you'll save a little more, and it gives you the emotional strength to stick with your plan when things get scary. And this right here is the final, crucial takeaway. I want you to remember this. Most people don't fail at investing because they picked the wrong stock. They fail because their unrealistic expectations cause them to make the wrong moves at the absolute worst times. Understanding this doesn't make you a pessimist. It makes you a realist. And in the world of investing, being a realist is exactly how you win.
All sources and references for this video are listed in the description below. This video is for educational purposes only and does not constitute financial advice. Please consult a licensed professional for your specific situation.